So today we have Chinmay with us. Chinmay is the CIO and the fund manager with a multifamily office called Phineas. Phineas caters to the needs of the clients in the ultra HNI segment and provides them a variety of services. So Chinmay's background, he has a decade-long experience in capital markets. He's running funds on the private equity and venture capital dimensions. Uh, he's also, in his prior life, he's also been a consultant with PwC for financial services in the London. And he's built high performance teams in the past and worked with companies like American Express, Barclays. Uh, One of the interesting things that I found while interacting with Chinmay is he mentioned that he looks at public equities from a private equity perspective, which I thought was kind of a unique way of looking at things. So Chinmay, we are excited to listen from you, and without much delay, I'm going to pass on the session with you.
Thank you. Thanks, Utkarsh. Thank you, Lakshmi, and thanks to the team at Toastmasters for inviting me. I hope I can do justice to the session that you've given me today. I'll just speak a little bit about what we do here at Phineas and at Cambridge Wealth, and then we'll kind of proceed on to a couple of topics which seem very, very relevant in the current times. As you all know, we are going through an unprecedented kind of a pandemic that we've not seen in probably the last 100 years. And the interesting piece is that all of us as a human race are going through this, which is another very, very differentiating factor about the current times that we live in. What interests us a lot is how do markets, how do people, how do economies, how do companies behave in such times. We've done a lot of in-depth research on how they have behaved, historically, or another, over the last 100 years, whenever there was an unprecedented kind of an environment. And I'd be happy to share some of those learnings with you as we go on today. Thank you for inviting me once again. Welcome everyone who's joining this session. And we hope to have a healthy question and answer round once we are done sharing some of the insights that we are seeing in markets today. Coming to Phineas, I'll explain a bit about what we do. Phineas is a multifamily office, like Utkarsh mentioned, that works with very few select families across India. Our approach is to diversify family wealth and to ensure that it transfers across generations in a healthy, sustainable, and growing manner. We work across diverse asset classes. We look at things which are absolutely away from public markets, like art, for example, to private equities. A lot of our approach is very deep, ownership-oriented or ownership-driven, owner-driven, holdings in companies. We don't look at them as very kind of frivolous tradable goods, really. So we are ideally perpetual long-term owners of good franchises across India and the world. We look at specifically economies like US, China, and a lot of concentration on India because we happen to be in an extremely well-placed economy over the next 10 or 20 years. And we have a really long horizon for any client that we work with. For our clients, over the last 4 years, we've structured several different asset class oriented portfolios that have delivered sustainable growth and that have delivered an ease of transfer of wealth over a period of time. We also work extremely closely with all our client families to help them transition and make sense of turbulent times, because a lot of them have interests in several different sectors, several different franchisees, and several different assets, even previous to having worked with us. So we consult with them on a very intimate basis to understand where they are and how to make sense of where we are currently and move ahead. So that's a little bit about what we do. And I'll get a little bit into what we'd like to speak about today or what we'd like to see today. There are 5 things that I'll be focusing on today, and I'll briefly speak about each one of them, and then of course questions welcome about all of them. I spoke a little bit about Corona. We'll look at the impact of what has been happening and how to make sense of what's been happening. While we don't intend to read the future, we do have a perspective of the past and the way people, societies, markets, and economies have been behaving when faced with such a kind of a illegible situation where the future is concerned. So we'll speak a bit about that. Post which I'd like to talk about the global perspective a little bit, focusing on US and China specifically, because both these economies are extremely important and also undergoing very different things, especially China, where the virus seems to have originated. I'll speak about the Indian market and the way it's been behaving. Post that a little bit. This is a broad macro perspective. We will not be speaking about specifics, but then we will come on to sectors, which is the 4th thing I'd like to speak about. How are certain sectors doing in the market and where they are placed? How are they attractive? Are they not? And why? Anytime we speak about a fact on this call, the understanding would be how to evaluate that fact that has happened, rather than just look at facts, right? And that should give us better and better insights as we go along. I hope that will help you, in the future when you are evaluating some of these pieces. From sectors, we'll try and understand valuations a little bit, and what do they do, and what does an event like this, which is a large event in the short run, but could turn out to be a blip in the long run. We are certain that things will change, but a lot of the growth and structural attractiveness continues to remain. So we'll look at those valuations, and we'll look at what is happening to those valuations, and then we'll open it up for questions. So these are the 5 things I'd love to speak about today. Let's start with the Corona virus piece. We all, you're all kind of, there is no one, unless you're living under a stone, no one's freed of this impact. Everyone's, looked at their lives dramatically change over the last month or so. But what's happening with the economies, right? So most of the economies have declared a lockdown to curb the spread of this virus. A lot of it is because we don't understand what it can do, rather than knowing what it can do. India, when you come to India, it may slip into a recession for the first time since probably 1990 or something like that, because in the last few recessions, we've kind of very comfortably skipped and come out very clean. The IMF estimates that we could slip this one by with a minor kind of recession, but it remains to be seen how it pans out. The biggest challenge seems to be on the logistical front in the current pandemic. It is logistics that is crippling the economy and causing severe disruption in the markets as a result. It's important to understand the role of logistics, because it is the single kind of, it's the oxygen supply for the economy. So if goods and services are produced at one end and cannot be delivered to the other end, and vice versa, it is extremely difficult for any economy to survive. So what we are really seeing, what is unprecedented about this whole Corona piece, is the complete breakdown of logistics and supply chains in the country. The government is trying to work pretty hard towards getting a grip on these, but I think everybody agrees that there is a lot of disruption around these. It remains to be seen how fast we can get back on track with the logistics bit, but yes, logistics is a key part of the economic breakdown. The other piece that is severely affecting the economy is the shutdown of processing and manufacturing plants and units, because it's not just the shutdown that hurts, right? It is the opening up and the difficulty of reopening them, the disruption of professional supply, disruption of labor, manpower, all of these pieces are extremely difficult. There are utilities challenges as well in the economy today, but they've been very, very well handled by the Indian government so far, and therefore we've not seen any large utility disruption in the economy. That's a positive, and that's a plus point. Globally, there has been a very, very fast and extremely aggressive response to the corona virus. Global banks have flooded the system with liquidity. The RBI has cut its repo rate as well. We've looked at the GDP, and they've looked at how to shore up the GDP. 10% of the GDP has been declared as the fiscal support by many economies, which is huge and unprecedented. We have never before seen, about 10% of GDP as a fiscal stimulus, really. This can rebuild the supply chain pretty quickly and support demand post lockdown. In India, it's a very interesting situation that we are in. So if you look at the US, for example, about 70% of US consumption is discretionary, which means it is non-essential and it is non-compulsory. In India, it's exactly the other way around. So about 70 to 75% of our consumption, arguably at any point of time, is non-discretionary, which means people cannot not spend, cannot not consume on those goods and services. This is an extremely positive fact for the current times, because that really tells you that you have a sort of an insurance up to 75% of the GDP consumption that is happening from the economy, which will lead to a faster, bounce back, a faster growth rate, after the crisis is over, because really we have no choice. We need to kind of consume those goods and services. If you look at an economy like the US, vice versa, it's very difficult for them to come out of something like this, because all the discretionary spending drops, right? Why is spending so important? Simply because one man's spending is another man's income, right? One company's spending is another company's income. And if you stop spending, income stops. When income stops, creditworthiness drops. When creditworthiness drops, you have banks sitting on liquidity but not giving it out, right? And that is what gets the economy deeper and deeper into recessions. We are seeing the fact that the Indian central banks have announced a lot of stimulus and liquidity support measures, followed by the buoyant consumption, which is non-discretionary, of about 70 to 75%. And this should enable us to get moving and come back much faster. If you look at a concurrent event, which is not perhaps not completely related, but somewhat related to this, is the great oil fall that we have seen over the last month and a half. Oil actually touched negative futures for perhaps the first time in the last couple of decades or ever. This is a very interesting piece as well, because oil actually fuels a lot of the costs in sectors, right? And if you look at India is a huge net importer of oil. A lot of our forex bill is made up of oil, and therefore it really saves us a lot of money when it comes to oil. Cheaper oil means cheaper commodities that are oil residues and oil byproducts. And that gives a stimulus to our industry, especially if you look at energy-intensive sectors like steel, cement, or oil consumption sectors like specialty chemicals, plastics. All of these sectors get a fillip and get a stimulus as a result of low oil. So that's an extremely interesting positive development that has happened. So this is the corona and what's happening globally around it. If we look at the US market, it shows an extremely interesting pattern. Like I said, it's important to understand what is underlying what is happening, and that's what I'm going to try and explore in this call, so that all of us together can understand why things are happening the way they are, right? Look at it this way: the US has seen an 11-year continuous rally, it has not witnessed such a rally in about the last 60 to 70 years, which means uh, probably the last such kind of huge rally was after the Great Depression that they had. Um, this last 7 years were actually far better than the last 60 years in the US market, which is also a significant fact. In the last year, the US GDP grew at probably about a 2.21, 2.22%, which is not bad. But if you look at corporate earnings, they were flat in the next year, right? Now, against flat earnings, the index was continuously rising, right? So you have to look at, so for example, if you look at the fact that our total client assets exposure to US to the US economy was less than 3% as at January 2020. Why have we allocated so little to a fast growing dominant economy in the world? The reason was because we could see these pieces rising and therefore we held back. If you look at the market capitalization to GDP, it was at a 1.5 times, which is really, really high, as far as growth goes, as far as comparative growth goes. And as of Jan 2020, all valuation ratios showed an all-time high, which left no real room to grow for stocks, right? For example, the net profit margin was at an all-time high of 17 years. How do you grow from here? One can't see that. If one can't see it, one should not enter it, right? We would like to err on the side of caution when it is to do with managing a portfolio, because it's extremely important not to the return of capital is extremely important rather than the return on capital when you're looking at extremely high highly valued markets on a slowing down economy. So that's absolutely critical. You can well imagine that the US economy is now in trouble. There is a 5 to 10% contraction over the next few quarters that can be seen in the US markets, and the corporate earnings may drop to about 10 to 20%. However, the fall in those markets has thrown up some very, very interesting opportunities, and we are selectively allocating to these opportunities on behalf of our clients. If you look at the Indian market, though, now imagine, we've seen a kind of picture of the US market. If you come to India, you see a very, very different picture, actually. So take the same period, right? Take the last 10 years where the US was on a huge rally. Sensex in India has also grown to about 150 to 100%, right? Big growth. But the reason for this movement was largely that the addressable market has been growing in India. So the market size is a very important factor in growth of Indian indexes. Market cap was 2.1 trillion, which is not very high. So that leaves room to kind of grow still. About 77% of the market cap, though, was top 100 Nifty companies. So if you see that a lot of the value or a lot of the valuations, a lot of the optimism was concentrated in the top 100 companies. Even over the last 10 years, if you look at it, it's always been between 70 and 80%, but this was like a kind of an all-time high things that we were seeing. The composition of the market is very interesting, right? So if you look at the promoter group, they were holding about 55%. Now I'm talking before the fall, but it's very interesting to see how it was shaped up. So before the fall, about 55% promoters, about 20% foreign institutional investors, domestic institutions held about 13%, and just 12% was left for all of the other groups, right? All of the other groups are many different kinds of holders, but they're largely retail investor driven. So only 12% of the market is actually being participated in by some of the retail investors that we're talking about. And even if you add domestic institutional investors, we just have about 25% of participation in the market. Now, this is an extremely key event, because the fall that we have seen is largely because of the foreign institutional investors selling in droves at this point in the market. That's extremely interesting for us because it has nothing to do with the economy and everything to do with how the US is shaping up, right? So very, very well valued companies with strong fundamentals and strong prospects, good growth, little or no debt, have also seen a fall as a result of the pandemic spreading in the US, which promotes, which gives us a very interesting point of entry into some of these asset classes. Similar things have been seen across other asset classes. I'd like to speak a little bit about um, everything we're using today, in our homes. So if you look at it, what do we use today? What are the kind of services? We use internet services. We use delivery services like Swiggy, Zomato, etc. We look at services that can be very easily virtualized or allow us to virtualize ourselves. We're speaking through YouTube. We're speaking through Zoom right now. All of these kind of pieces are essentially companies that are new economy companies. Now, these new economy companies are extremely interesting to us because we like to diversify some of our portfolio assets into such companies that can show huge growth for the future. So everything we use today, everything is central to our lives during this corona crisis. And as you know, the world will not go back completely to what it was before, but some of these services have become embedded and centralized and dominant in our psyche now, and they will continue to operate with better and better growth than before. We have a very detailed view on this and very optimistic exposures to these alternative investment classes through our through the venture capital strategies that we build for clients. If you look at some of these larger companies that are also a part of the new economy, they then come into the to the private equity spheres where we have some participation in them as well. So extremely important to look at things that are emerging very, very quickly in the market and growing at 60, 70, 80, 100, 200% year on year, which is an unheard of growth in public markets. Coming back to the market a little bit, when the FIs hold 80% of their investments in Nifty 50, what we saw was there was a large cap bias. Over the last 2 or 3 years, there was more and more value going into large caps and less left for other healthy, good companies. So in fact, we had reduced our large cap exposure significantly before the fall. And we're now looking at some interesting plays in that sector. One important part of something I wanted to talk about is the sectors that are showing different signs, right? So as you have seen, all sectors have been kind of beaten down by the market, but are they all equal? Are all sectors facing the pain equally? Are all sectors, equally affected by the pandemic that we're facing? And the answer is no, and that's what makes the equities participation or participation in economic growth pretty interesting and also difficult to participate in, because during times of great fear, during times of great pessimism, such as the times we're seeing now, investors tend to paint the entire market in the same with the same brush. They tend to paint all companies through the same brush. So, for example, you have a company. I won't name specifics, today because we don't have time to get into specific valuations. But if, for example, we have a portfolio company that is an excellent, it's one of India's largest private employers. They have excellent economics. They have a very sticky business model. But the entire company is available for about 12x earnings, a company that has been growing more than 20% year on year, showing phenomenal value accretive acquisitions and really healthy, return on equities, is now trading at, say, about 12x price to equity. I haven't seen a better opportunity than this in the last 15 years in the Indian markets when you look at how these companies behave and what kind of period actually leads you to larger gains in subsequent periods. This seems to be an extremely interesting time for sure. I will not look through the glass ball and predict outcomes, but and we'll go through some of these ratios, but the ratios are looking extremely favorable for better returns in the coming 24 months, 24 to 36 months in the market. The other extremely important piece in the Indian economy is the bear ratio, right? The bond to equity earnings yield. Extremely favorably placed, most favorable position in the last 15 years. What the market is doing is it is valuing bonds higher at this point than equity earnings in the market, and that, as we've all seen, often results in equities outperforming over the next 24 to 36 months. So that's an important piece as far as the earnings growth. If you look at sector, the crude price plays a large part in sectoral earnings, right? Starting from the top, the most affected. So we've seen anything that requires large concentration of people in a public space is severely affected. So your media, tourism, hotel, entertainment sectors are hugely affected right now. Of course, displaying the same pessimism in valuations as well. So remains to be seen how they step up. But they are seeing structural shifts. They're seeing structural changes to the business that may not reverse completely over a period of time, or may take a long time to reverse. As they say, the markets can remain more irrational than you can remain solvent. So we got to be careful when touching these sectors. We need to analyze them very, very well. If you look at services are not seeing as much disruption as some of these other sectors. However, services will be affected over a period of time. There are structural changes happening in the economy. The US economy is trying to insource a lot of its business that it has outsourced over a period of time. There is a huge mega trend of deglobalization which had begun about 24 to 30 months back, which is accelerating today. People are giving calls to exit company dependencies on China and look at how to insource. Now that will also affect the part of the services built out of India when people are trying to be more and more self-reliant. Lower commodity prices are extremely interesting. So we are getting to lower commodity prices because of largely crude and the price of power as a result of that, but also because crude is an key input material in a lot of sectors. We are looking at commodities. Now, who will benefit from these commodities? It may not necessarily be all commodity companies, but largely a company that consumes commodities but has pricing power as far as the output product goes, right? So, for example, if you're buying oil but you're selling a plastic product that has a huge headroom to grow, you have a sustainable brand that protects yourself, you're very likely to benefit. So we are seeing some of these pricing power companies benefit a lot. Sectors like painting, cement, construction, lower oil prices are a huge benefit. No permanent loss or no structural loss to these industries is something we're seeing, and that's an interesting development. Along with that, the consumption story, India has always been a consumption story. It continues to be a consumption story and looks like it's nowhere to go, but up. Consumption is a strong, FMCG, F&B consumption, huge kind of fillip to that sector, because that's one piece that is not stopping. Durables have a slightly longer horizon to grow, so we're seeing some near-term issues, but we're not seeing structural issues for consumer durables. Pharmaceuticals and chemicals are extremely interesting for two reasons. One is the whole pharma industry is extremely well placed to earn in the near run because of the outbreak right now. That's one part of it. As far as chemicals, especially specialty chemicals go, there are a lot of global players looking to de-risk from China, and hopefully India will be the next port of call for these companies, looking at specialty chemicals especially and chemicals in general. And so we need to, so we are looking forward to seeing growth in the near term for these sectors. Financial and life insurance are really the lifeblood of the economy, very low penetration. Awareness has gone up now, especially in periods of uncertainty, things like insurance go up. So we're seeing a lot of growth, expected growth in insurance. Global interest rates are low. The interest rates in India are the lowest in the last perhaps 15, 20 years. And the system is being flooded with liquidity. Now, this is a very interesting thing, because when the system gets flooded with liquidity during times of crisis like this, central banks around the world and federations such as the IMF or the World Bank have no choice but to flood it with liquidity to keep the economy going. When in very simple terms, this can be made, this is, pretty complex to arrive at, because there are several indicators one needs to look at. But if I were to kind of simplify it, when the system is flooded with liquidity, there is greater purchasing power in the hands of people that is given by government specifically, and by credit agencies on a secondary level. You then see that consumption or that liquidity flow towards preferred goods and services. When those grow, earnings of those stronger companies grow, and eventually that gets into asset prices. So you will see asset price grow over the next 18 to 24 months as a result of the glut of liquidity we are seeing today in the markets. So that's something that historically we've seen happening. We are closely monitoring to see what's happening now as well. Foreign institutional investors have been selling, but domestic institutions have been kind of entering the market. Now, this signifies the confidence of the investor on the ground in the Indian market. There have been promoters that have been buying and institutional investors that have been buying. This also is a great indicator of what it is likely to see. We look at the market as an undervalued market when these kind of things start happening. Sharp drops in the valuation front. We are seeing Indian markets are largely positioned at attractive levels on the valuation front now. So that from the sectoral back to the larger market perspective, that was about the sectors. If you look at more details on valuations, we're seeing pretty interesting stories come up, right? So if you look at valuations and the way the economy has been shaping up, or the markets have been looking for as far as valuations growth, the Indian equity valuation to market cap, right, to GDP is at about 0.55%, which is huge, which is at an all-time low. We've not seen this kind of a GDP to market cap valuation in the recent times. If you look at a deeper kind of data that is coming out, which is price to book, that is also at about 2 times. It's at an all-time low in the markets today. That's an interesting piece. Return on equity is at about 9.5 to 10, which is at more than a 15, about 17, 18 year low. So which means it is really a low point on average, all companies returning on their returns on equity to the market. So this is another interesting indicator, because it leaves a lot of headroom for growth. Corporate earnings are at an 18-year low, so the valuations do not reflect any positivities on the earnings side as well today. So that makes the valuations even more interesting. If you look at something like a price to book in 2008 and to price to book now, it was actually double of this in the crash of 2008-9 as well. So even at the crash, we were looking at double price to book than we are today. So you can just imagine the kind of valuation gaps that we're seeing, the attractiveness of valuations. Earnings growth of Nifty 50 companies was at about 27% back then. If you look at 2008, and it's not even about 7% now. So there was no optimism built into the market before they got even more attractive today. So those are some of the interesting pieces about valuations. So if you look at what we just saw, right? We started on the pandemic and the kind of impact the pandemic has been having. We looked at economies like US and China. And how they have been behaving and contributing or not contributing to the positions globally. Then the Indian markets, how they have been responding, who has been exiting, who has been entering, and how the markets have been evolving over the last couple of months now. Then specific sectors, which sectors are positioned in what way and why, in these markets. And then finally, we looked at valuations and the compelling valuations that we are seeing in the Indian economy today. So these were the 5 points that I broadly wanted to discuss with you. I hope the insights around these 5 points will be helpful for you to form your own understanding and perhaps decision-making models around these markets. Having said that, that's probably the end of my sharing from my end. I'll hand this over back to Utkarsh for any questions. I know we've been taking questions through YouTube, so any specific questions, very happy to answer.
Sure, Chinmay. So that was an insightful session, and I think throughout the session we kept on getting different queries on YouTube. So I'm going to read out some of the queries for you. The first query we got is from Jigar Shah. He himself is a VC fund manager. And the question that he wanted to ask was, how do you see family offices warming up to investing in startups and the VC funds? And second, what impact startup valuations will have due to the crisis?
Okay. So interesting question. Thanks, Jigar. I think a lot of insights around this one. We've been seeing this over the last 2 or 3 months, especially in the companies we had an exposure to, but also the companies that we are about to kind of invest in. We've gone ahead and continued on our investments. So your first part of your question is about VC investments and family offices in India. I think it's an extremely nascent sector as far as family office exposure goes to VC investments in India. It's largely looked at as the riskiest part of the folio. We've been working pretty hard to change some of these perceptions, because if you understand the VC sector on a portfolio level, it is not as risky as it is on a particular allocation level. And therefore, it's about how well you build the portfolios out rather than specifics of the companies that are invested in. Of course, the specifics are what make the folio, but over the folio level, if one can manage risks, and that is possible, then one can really see pretty healthy and good outcomes. This is the piece that we've been working very closely with the families that we work with on, and I believe there are green shoots there. There are positive perceptions changing. People are understanding how the sector opens up and is contributing to the economy and can contribute to sustainable wealth and value creation in the economy. So progress there is what I would say. As far as valuations and investments go for venture companies, I think, when you start looking at companies across the VC, PE, and public markets sectors, you see pretty clear, distinct patterns. So if you look at recovery, and I'm just going back to the public market because there are a lot of data that is available for public markets. The VC and PE are still under shadows, in that sense. Data is not very, very transparent or easily available. So if you look at public markets, you will see that some of the companies that fell up to 45-50% of their valuations over the last 1 month have not just recovered, they've overshot their original valuations. The reason for this is that they are strong economic franchises that will not see disruption during these times and emerge even stronger than these. And investors are responding to these, to this kind of a strength that they are seeing in certain franchises. Similarly, the VC models that were not built on an infinite cash burn and buying engagement on a cash burn basis only, without generating a strong brand preference or strong repeat consumption preferences over a period of time, are likely to see good investor participation returning. We've already seen some of these close pretty large rounds in the last month or so. We will see more of this going ahead. So I like to look at these kind of economic bumps as kind of a cleansing of things that happen, right? So there's a lot of weak models that come into the marketplace when there is optimism, because there is a tendency to assume that if I build it, they will come. And that's not always true. In fact, it is true very rarely. And we see a cleansing every 10 years, right? So the last cleansing you saw was in 2009. Before that, you saw one in 2001, the great dot-com crash, right? Before that, in India, you had one in 93. So roughly about every 10 years, you'll see a cleansing, and it's extremely essential structurally, although very painful individually, and we're very empathetic towards those who are undergoing that pain. So not to say that that pain is justified or it doesn't matter, but the cleansing is in a way essential, and it leaves the sector stronger over a period of time. So I hope that answers your question.
Sure, that's insightful. In fact, I have a follow-up question on this. How receptive do you think family offices are towards investments and VC and PE? Do you see a lot of resistance there, or do you think that the times are changing and family offices are getting more sophisticated?
I think family offices themselves are a new, fairly new kind of concept in India, right? A lot of the holdings or portfolios so far were by default and not by design. That is now changing. So that is trend A that is changing. When that changes, it kind of formalizes this and structures the industry out. So there is a tendency to paint a one size fits all kind of a piece to a PE or a VC kind of a sector, and one has seen time and again that is not true. So there is an awareness and education piece that needs to happen there, and I can speak for ourselves that we are focusing on that pretty strongly. Once that happens, one sees that there is a profitable exposure and contribution to the economy through these sectors as well, and there we are seeing then good allocation towards these sectors. So to start with, are they open? No, not very much. But once there is an understanding of what it can do to the folio and what it can do to the economy, there is a good participation that we are seeing coming up.
Right. So you're saying there is acceptance post-education?
There is growing acceptance is what I'm saying.
Okay. All right. Thank you. Chinmay, there are a lot of questions from different people here, and I think all of them are on the central theme of the asset allocation. For a retail investor, who has a full-time job, what is your perspective on what could be an ideal asset allocation in the current environment? Especially, I'm getting a lot of questions on gold here. There are some questions where people are asking about allocation to fixed income and equities. And do you think this is a time to get into the fresh equities or add the allocation to equities in the current environment?
Okay. Let me take that up step by step, right? Your position as an investor is the biggest driver of asset allocation and should always be, right? So in other words, what do I mean is if you are able to very comfortably see volatility, there is no class like equities to really achieve growth over a period of time. Especially right now, while bonds are also looking extremely attractive, or they're placed at their most attractive place in the last about 10 years or so, you will you'll make a good kind of position in bonds. So I would say if you have discretionary savings which are not required to be liquidated, or which do not have an end goal that is less than 5 years, I would say look at some bonds, about 15 to 20%. These are really volatility stabilizers or kind of liquidity in case of requirement kind of a piece. Look at a large portion in selective large cap equities today. because they're looking extremely favorable and the first ones to kind of return from the crisis. They're stronger companies. And then look at about 20% or so in your more kind of interesting sectors like your mid and small or multi-cap kind of allocations, because that's where the large bumps in your folio can be seen. So they have the ability to push up your folio in a way that the other two sectors or other two allocations that we discussed do not have. So that is what I would say would be a good perspective for a retail investor. Gold has seen a huge rally over the last 12 to 18 months. While it is difficult to say where it's going to go in the future, it is extremely important to understand that in the most pessimistic times, investors flock to cash and gold, which is what has happened today. And therefore, they're least placed to get any more growth at such times. And adhering to the adage that be fearful when others are greedy, which goes for gold and cash today, right? And be greedy where others are fearful, which is largely equities today. If you look at it, will stand you in good stead in times to come.
So are you suggesting that now is not the time to be sitting on the cash, and probably you would recommend investor to go all in the equities and bonds?
I'd look at investing in probably 3 to 5 tranches over the next 4 to 6 months. I would not look at an all-in scenario right now. But what we are seeing is that the valuations are favorable right now. Will they get more favorable is a question, and therefore the next 4 to 6 months, investing in tranches over the next 4 to 6 months would be a good way to get into it.
Right. Okay. All right. That's insightful. Let me pick up some new questions here. Sorry. Yeah.
That I'd like to add about this. It's a very contrarian view. So there will not be too many people in the market advising this, but I'll go out on a limb and say this, right? When you look at cash, there is a sense of security with the retail investor, right? Now, this sense of security is a little flawed because what one discounts is the inflation, right? And if the economy truly goes to the dogs, there is a huge hyperinflation possibility that happens, right? Which means the cash that you're holding on hand reduces in value year on year to a significant level. One discounts that because there is a kind of feeling of I have these kind of say 100 rupees with me and they're staying 100, but they're not, right? With 10% inflation, they're getting to 90 rupees tomorrow. That's a very real and interesting possibility to look at. Whereas if you look at equities, they're available at an all-time low. So the earning power represented by equities is available to you at a lower pace than bonds are available today, right? So the bear ratio is actually 0.97, which is your equities are more attractively priced in terms of yield than your bonds. To your cash, which can actually decrease in value over a period of time. You look at it this way, it becomes a kind of a no-brainer situation. So that's the answer to your cash question specifically.
Interesting. But do you not think that keeping in mind to the point of hyperinflation eating the value of cash, but one of the thing, okay, I think it's an internet at my friend. One of the thing you get with cash is a lot of flexibility, which gives you opportunity to buy in at attractive levels. So do you think that argument would not be valid here?
No, it's absolutely valid. When one looks at cash as purchasing power into future purchasing power, right? That's an absolutely valid argument. And therefore, what we're saying is we will invest in tranches over the next 4 to 6 months.
Right. Makes sense, yeah.
Yeah, you'll make the most of your kind of dry powder that is available to you to purchase the maximum kind of, future profits at today, right? So absolutely. So do not go. So that's why my answer to your question, should we go all in, was no, right? Let's deploy over a period of time because we don't know the short-term fluctuations in the market. Really.
Yeah, makes sense. Okay, by the way, just a legal disclosure, all of this session is for learning purpose and none of this is an investment recommendation. I think it's just to protect both of us. So please do your own research before you take any investment call based on this. All right, Chinmay, so very interesting. I'm going to go with probably the final question. So there's a sentence, that I mentioned at your introduction, where you said that you look at stocks, public stocks, from a private equity perspective. So can you give us a little bit insight on, what's your thought process and what's the template through which you look at stocks and the selection process?
Yeah, sure. So I'll just start with an insight. You see, the market is a place you go to trade ownership, right? Now, if you do not have if you do not have a particular investor mindset, the market actually acts against you instead of for you. Why does it do that? Because if you look at the market as a person, right, it's a pretty bipolar kind of a person. It keeps throwing values at you several times a day across a period of time, and it becomes more and more difficult if you're not positioned as a on the private equity kind of a mindset to say keep saying no to the market or know when to say yes, because it's just a lot of noise and very little signals coming in your way. If you look at the flip side, right, if you say, what if I was a private equity investor, which means there is no particular place to go and trade this stock today, right? However, what could then the ownership of this company or a part ownership of this company or this franchisee, or it could be an asset, a particular asset like say commercial real estate or gold or whatever, how would this stand me? In what stead would it stand me over the next say 5 years, right? Uh, and if you arrive to an analysis that is favorable on that perspective, you then stop caring about what the market is saying about that particular equity, right? We have found that this kind of a mindset is extremely rare and therefore extremely valuable. Um, and therefore we actually systematically weed out a lot of data that comes in on the short run, because it's very easy to get seduced by short term data, and that's what causes these kind of v-shaped kind of pieces that we've been seeing, even in the last 40 days. If you look at it, there are some companies that went from 100 to about 52 and came back to 110 all within 30 days. Now it is economically impossible for a company's prospects to change that rapidly, right? So what that means was, at the point that it went to 52, it was absolutely inefficiently priced by the market. That has shown itself to be a very fickle-minded kind of individual. Should I believe that market, right? If I believe that person who is coming and throwing lower and lower numbers at me every day, then I am tempted to buy into that fear. However, if it does not matter to me what the market is saying, but my analysis of that company shows me that it is attractively placed, then I don't care about the 52 number or the 70 number, and I do not look at that as a loss. I think perception of loss is an extremely important piece there. There is a loss aversion piece deeply built into our amygdala as humans, right? So when we evolved as Homo sapiens, in a forest, if you missed a couple of fruits, you would not die, but if you missed a tiger, you would die, right? That has built a very strong aversion to loss in our mind, and that's as a species we face that. However, today we live in times where there are no tigers, but there are a lot of fruits, right? Um, Tigers are in the process of not asset prices, but in the process of earning power loss over a period of time on the asset that you hold, right? That's the tiger. So focus very, very well on that tiger in the bush. Make sure you're not holding any of those tigers lurking at you. And beyond that, you don't have to worry about the notional on paper temporary loss that is thrown at you because of vagaries of the market on a day-to-day basis. This is what we mean by a private equity approach to public markets. Did that answer your question?
Yeah, absolutely. I think that's insightful. It reminded me of this famous quote from Warren Buffett. I recently heard again 1,000 times in his CNBC interview. He said that we don't buy stocks, we buy businesses, right? And then stock price is just a signal, but how importance do you want to give to the signal is again a question.
Right, and probably the only point of importance is that it is even more attractively priced than I thought it was. And that's an important signal. But beyond that, to look at signals, doesn't make sense on a daily basis.
That's insightful, Chinmay. Okay, so I think we wouldn't take much of your time. So with this note, we'll like to call it a day. It has been an extremely insightful session. For me, individually, I think there were a lot of points that I'm going to take away and think about, and probably try to apply that in my portfolio. Something that really got me excited was when you were talking about the new economic companies. So clearly in the listed environment, I'm not sure how many opportunities would be available, but that's something definitely I would like to think about. And I would also like to research a bit more about the mega trend that you spoke about on deglobalization. I thought that that's very interesting. And while you're talking about it, I was thinking of a couple of stocks in my portfolio, which I thought are going to be hit badly if that really happens. So overall, Chinmay, I think we learned a lot. Thank you very much for the opportunity. On a closing remark, one final question that I would like to throw, since a lot of these people are students who are participating in the session today, how does, if all of us want to know, how does one make career in family office space? What kind of skill sets do we have, and what courses do we need to do so that we get a job with someone like you?
I think two things, and one part of it is neglected a little bit, so I'd like to kind of highlight that. So the first piece that is usually kind of focused on by someone who wants to make a career in this piece is the analysis bit, right? Where you say, I must learn about financial markets, I must learn about stocks, equities, how do asset classes work, operate. And while that is absolutely important as a foundation, what we see on that there is an entire other side as far as client management goes, which is a sort of neurobehavioral investing patterns, right? And neurobehavioral investing sciences or behavioral sciences are extremely important as far as management of other people's capital goes, because that's a key part and a key learning for us is that it is equally important, if not more, to understand this neuro behavior and to understand the way the human mind responds to situations, which is not always rational. So the boon of economics is that it makes everything rational, and the bane is that it assumes everything is rational. Right? Our job is to be the harbingers of that rationality by understanding the fact that there is a lot of irrationality in human decision making, which we get through neurobehavioral studies. So I would focus on those, and that would probably be my suggestion.
All right. So I think that's it from my side. Thank you very much once again, and hopefully we'll have you some other time post lockdown to have a more physical interaction with the candidates. So thank you very much. You have a great day and keep yourself safe.
Thank you so much. Thanks all. Thanks Utkarsh. Thanks Lakshmi. Thank you FinTree Toastmasters. Thanks all.
All right, guys. So signing off from here. Bye.